Welcome to Mind Your Money. I'm Allie Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, tariffs are causing prices to rise in several key areas. We bring you the latest on how inflation is impacting your wallet. And we give you 5 ways to make money online. Plus, most 401k savers play it safe when it comes to their investment strategy. We'll get the latest retirement trends and themes from an expert later on in the show. The Consumer Price Index showed inflation rose 2.9% from the same time 1 year ago. Core CPI, which strips out the volatile categories like food and energy, increased 3.1% year over year. But what does that mean for you and your money? Yahoo's own personal finance reporter Emma Ockerman joins me now. So Emma, what were your biggest takeaways from this report?
I mean, definitely all eyes on the Fed, right? But I mean, inflation definitely is looking stickier than perhaps we might have thought. We're starting to see some tariff pass through. This did come in slightly hotter than expected, with some categories in particular driving increases. We saw higher prices in food, higher prices in airfare, and then again, some tariff sensitive categories like furniture and apparel.
You mentioned food, and this was an acceleration compared to what we saw in July. Within food, what are the categories that are the most sticky?
So I love to nerd out about this. I'm super interested in food prices. There are 2 categories in particular that really interest me. One of them is coffee, and we've seen prices for coffee rise almost 21% since last year. And if you're a consumer who drinks coffee every day, this is probably one of the most noticeable noticeable inflation impacts for you. So coffee prices are rising for a few reasons. One of them being that we've had adverse weather conditions in some major coffee producing countries. Another being tariffs. Brazil is facing some of the highest tariff rates in the world. It's also a major coffee producing country, if not the largest coffee producing country. Another interesting thing that's going on with prices is in beef. The prices aren't rising quite as much as coffee, but they're still up substantially year over year. 2 things sort of driving this trend. One being intense demand. Of course, red meat is kind of seen as all American. The second being, we have seen a number of Americans increasingly go on diet drugs that have sort of driven them more toward fewer meals, but also protein and fiber-rich meals. And beef certainly packs a punch when it comes to fiber content, protein content. And there are some other things too that could be potentially driving prices higher. One of them being that the overall cattle herd, like how many cattle are available in the US, it's actually at its lowest level in 75 years. A few things are behind that trend too. One of them being price conditions are causing ranchers to sell. And we're also seeing that drought conditions, similar to what we had kind of talked about with coffee, are driving prices of feed higher, and then the interest rate environment is also causing ranchers to not necessarily expand their herds because it's expensive to do so.
Okay, so a little bit of tariff impact there with the food for the cattle, it sounds like.
Potentially.
Okay.
Tariff and drought, but we definitely, I would say, are seeing tariff impacts on coffee and some on beef too. Even though the U.S. is the world's largest beef producer, we also do import a fair amount of beef, also from Brazil, particularly lean beef that's used in ground beef mixes.
Well, I understand why you nerd out on this because this stuff is super fascinating. So then in terms of the bright spots, were there any in this report? What stood out to you?
I mean, higher prices are never great news for consumers, but I think one thing that stood out to me is even though gasoline prices were up on the month, year over year, we're still seeing some of the lowest gas prices we've seen in years. So if consumers hit the road for Labor Day weekend, they might have enjoyed lower prices at the pump.
Now, this is data for August, so it is backward looking. What can we glean from this when we look ahead to the future and really the rest of 2025?
I mean, definitely, I think what everybody is going to be keeping their eyes on is continued tariff pass-through. Even though we are seeing some signs that these prices are being passed on to consumers, we know that companies, for now, have largely tried to keep prices steady or absorb costs where they can. There's been a lot of uncertainty in the market. We also know that the de minimis tariff ended late last month. I don't think that higher prices are unlikely. It's especially going to be interesting to see how much prices rise before the all-important holiday shopping season.
Yes, all eyes on holiday shopping. But Emma, stick with me because I also want to talk jobs. And the headline U.S. unemployment rate has held steady between 4.0 and 4.3% since May 2024. But if you look closely at the data, some groups are struggling more in the job market than others. Emma Ockerman, personal finance reporter at Yahoo Finance, is still with me. And you've been reporting on this, the Black unemployment rate. That's at its highest level since 2021 and nearly double that of white workers. Why is that typically a warning sign for the economy?
Right. So we know that the Black unemployment rate is often higher than the unemployment rate for white Americans just due to structural inequities in the labor market. But some economists see the Black unemployment rate as kind of a canary in the coal mine. Since some Black workers are considered last hired, first fired, when we're in a downturn, we can start to see the Black unemployment rate tick up than we see it before we see it tick up for other groups. There are some sector level explanations though for why the Black unemployment rate may be rising. One being that the federal workforce actually had a substantial share of Black workers, and of course we've seen large-scale layoffs across the federal workforce this year. Logistics also employs a fair number of Black men, and that sector has been hit hard by tariffs this year.
And it's not just Black workers, but also younger workers. And the unemployment rate for young workers that reached 10.8% over the summer. Why is that? What's that telling us? And can you define how the BLS categorizes young workers?
So I think it's 16 to 24, right? So one reason why we're potentially seeing young workers struggling is we know that we're in kind of what some folks have called a frozen labor market right now. People aren't leaving their jobs because they're worried about the state of the labor market, and firms aren't really hiring because they're worried about the state of the economy. Who winds up struggling in this scenario is young workers that are looking to sort of get a foot in the door and enter for the first time because they can't really gain those entry-level positions, both because firms aren't hiring and because people just aren't leaving their jobs. What worries me about this is that while this could be a trend that we see this year, these workers not having that sort of first mark on their resume could impact them for years to come. And you're definitely seeing that it's weighing on their sentiment.
And we did see another survey out this week that showed from the New York Fed that even those who are employed, they're losing confidence in their ability to find a new job. What's weighing on that perception? Obviously, like you've been talking about, there's a lot of uncertainties out there.
Right. I mean, part of it could be that they're watching shows like this and that they're paying attention to the data. Another huge part of it, I think, is if you are just a person who exists on the internet and uses social media, you have probably seen negative stories about the state of the job market. I mean, I feel like I can't go a day being on TikTok or LinkedIn without seeing a story of somebody who has great qualifications, but has submitted dozens of applications and hasn't heard anything back yet, right?
Ghosting in the job market.
Ghosting in the job market. And we also know that some people, when they're going through this process, they're also facing perhaps AI resume scanners, or maybe they're even being interviewed by AI. And then, of course, there are some folks who feel, not unjustifiably so, that some of these entry-level positions no longer exist because they can be replaced by AI, which is especially true in fields like software development.
Yeah, AI is certainly changing the game when it comes to the labor market. Emma Ockerman, thank you so much. Appreciate your reporting there. Well, millions of Americans are finding ways to make money online, from side gigs to full-time remote work. Yahoo Finance personal finance editor Casey Bond joins me now. So Casey, you're looking at 5 ways that folks are making money online. Can you walk us through those?
Sure. Well, there are a ton of ways to make money online. Some are better than others. So our reporter did some digging to figure out which ones were really more proven and legitimate. One of those is becoming a virtual assistant. There's a ton of flexibility here, whether you want to work part-time or full-time. Tasks range from making phone calls to data entry. So that's a really great option. One that maybe takes a little bit less time is renting out your property. Of course, there are sites like Airbnb where you can rent out a room in your home or your entire home, but that's not the only thing that you can rent. If you have a car that you don't use too often, for instance, people can sign up to rent that from you. Or if you have a parking spot on your property that you're not using, that's another great way to make some rental income. If you're looking for something that's a little more like freelance or contract based, consider signing up for a gig website. Platforms like Fiverr and Upwork allow you to do micro tasks that range from data entry, photo editing, grocery delivery. So there's really a lot of options there. Additionally, if you have some expertise in a particular area, you may want to consider online tutoring or even course creation. Things like test prep and business English, coding are all pretty lucrative positions in the online tutoring world. Or if you want to create a course on a certain subject, you can use a platform to do so. And then every time someone signs up for that course, you get paid. And finally, if you're really looking to just make a little extra cash, not necessarily replace your full-time job, doing user testing is another great option. So you go on new websites or apps and you record your feedback in real time. You usually get a few jobs a week and they typically last around 20 minutes. So it's a great, easy way to just add a little extra cash.
Right, some really interesting options there, especially at a time when there's a lot of pessimism in the current job market. But one thing people do need to watch out for is online scams, right? What are the risks there and what can people do to avoid falling victim to some of these scams?
Sure. Well, like most things on the internet, job listings are going to have a few scams in there. People who are preying on the fact that you may be needing extra money, looking for work. So it's really important to be aware of these red flags. One of those is a job listing that promises you work without going over your qualifications or regardless of your qualifications. The same is true of any listing that has very unrealistic or unclear pay. So like a listing that says you could earn anywhere from $20 to $200 per hour, that's probably not a legitimate one. You should also watch out for anybody who reaches out to you like via a cold call versus you reaching out to them regarding a job. That's usually a pretty big red flag. And then, anyone who's asking you for money up front, stay away. There's, no reason for you to pay money up front for a legitimate job. And then it's, unprofessional communication, typos in the emails, just awkward language. It's usually a sign that the job is probably a scam. And then finally, if you're being pressured to sign up, that's usually not a good sign as well. There should be no urgency in you signing up for a job.
All right, very important tips to keep in mind there. Casey, thanks so much.
Thank you.
Coming up, retirement savers playing it safe even as demand for alternative assets are on the rise. But why now could be the time to embrace more risk in your portfolio? Stay tuned. Nearly half of retirement savers say they would take on more risk in their 401ks if they had the option, including investments like private equity and private debt. That's from Schroders 2025 retirement survey. But in August, investors played it safe. Data from Alight Solutions 401k index shows that trading was quiet last month with no above normal trading days. When savers did make changes, they shifted out of large and small cap equity funds and company stock and into more conservative bonds. Some money also moved into money market funds and to a smaller degree emerging markets. The reason? S&P Global says investors are growing uneasy about both the economy and political risks, and that's pushing them more toward defensive moves. Still, riskier options are making their way into retirement plans. Just last month, President Trump signed an executive order to make it easier for 401ks to invest in private equity. Growing appetite for risk has 24% of retirement plans considering adding alternative assets over the next year. That's according to a new BlackRock survey. Joining me now, Caroline Feeney, Prudential Financial Global Head of Retirement and Insurance. Caroline, let's start there. What are your thoughts when it comes to retirees taking on more risk? And is that something that you're seeing at Prudential?
Yeah, so Allie, first of all, thank you so much for having me. One of the things that we did within PGIM, which is our asset management organization, is we actually went out and did a recent study. And we did find that most plan sponsors are supportive of adding these alternative assets to their portfolios if it's a way of enhancing diversification and making sure that it's an offset to downside risk and inflation. And we also found that it's a way by which we can potentially enhance the retirement income by about 4 years or more.
Now, some retirees may want to take on more risk, but the reality is that the average 55-year-old has less than $50,000 saved. That's according to your data. What does that mean for people approaching retirement, and what can they do if they feel behind?
Yeah, so risk, obviously, Allie, very personal, depending on the person's situation, what they've already saved, their length until retirement. And yes, our study did show that 55-year-old Americans on average have less than 50,000. And the problem here is people are living longer, but that is woefully short of the recommended savings that people should have at this time. So at this point, what we recommend to individuals is seek the advice of a professional. We're really proud at Prudential to have 3,000 financial advisors who can help people navigate their own personal journey. So what's the level of risk they can accept? What do they envision for their retirement? And where are they in their journey?
And we are in this so-called peak 65 moment with more than 11,000 Americans turning 65 every day. And to the point you just made, people are living longer. So how is that combination reshaping the retirement landscape?
Yeah, so what we see here, Allie, is very much a retirement challenge. We view it as a significant opportunity for Prudential to lean in and provide much needed solutions and advice. As you say, 11,000 people turning 65 every single day in this country. They are living longer, yet they're not necessarily saving more for those additional years in retirement. So this is where we can step in with solutions, with advice and tools, and really meet those customers and clients where they are.
And for someone watching right now who does feel unprepared, maybe they're in their 50s or early 60s, what are the first steps that they should be thinking about in order to build more security?
Yeah, so it's never too late to seek some advice. And I think that's the important thing. I think sometimes people are a little reticent to seek the advice of a financial professional because maybe they think the questions they're asking might be silly. There really are no silly questions. And seeking the advice of somebody that's in this business every single day, and this is what they do. At Prudential, this is core to our business and what we're able to do to help support people, regardless of if they're just getting started in their journey, if they find themselves a few years out from retirement and they're not as prepared as they would want to be. And so, again, we strongly advise that people seek the professional advice that's needed to help them navigate their journey and help land them in a better situation in terms of their financial security.
Yeah, and September is also Life Insurance Awareness Month, and Prudential is the largest life insurer in the country. What's the biggest misconception you run into about life insurance?
Yes, so we are very proud to be the #1 life insurer in the country. And I think for us, very often traditionally you viewed life insurance as just a death benefit. And I think people don't necessarily understand that can be a wonderful way to build generational wealth. And today in this country, we're still facing, unfortunately, a $12 trillion life insurance gap. And so what that tells us is we still need much more awareness on how important life insurance can be to somebody's entire financial portfolio. We very much view it as the foundation of a house and making sure you have that much needed protection in the event of an early death. And so for us, September, as Life Insurance Awareness Month, we very much lean into that awareness and the education for Americans.
Caroline, great insights there. Thank you so much for joining us. And you can scan the QR code below for more from Yahoo Finance on insurance. It's time now for our weekly segment, Ask Yahoo Finance Anything, where we answer your viewer questions on air. This week, Yahoo Finance senior columnist Carrie Hannon joins us with questions that readers left on our recent articles. So, Carrie, people are very curious about Medicare as we're only about a month away from the open enrollment period. So let's jump right in there because the first reader asks, what changes can I make during Medicare open enrollment when it starts in October?
Yeah, that is an excellent question because, Allie, what happens is most people do nothing. And it's super important to take a look at your coverage at this time. You have until October 15th to December 7th to do all kinds of things. You can change from traditional Medicare to Medicare Advantage or vice versa. You can take a look at the prescription drug, your Part D. plan and make changes there. You can switch plans. You can enroll in plans. If you are in a Medicare Advantage program, you can switch between Medicare Advantage plans, because here's what happens. You want to check to make sure your current doctors and healthcare providers are still in that plan, because these things shift from year to year. Who is in the plans, what drugs are covered. So this is really your opportunity, and also your costs, what the cost shares are, what sort of costs you have that associated with these various things, the Part D plan, as well as deductibles and so forth. So it's really important to really review who your doctors are, what medicines you're taking, how that might have changed, and if your plan still is there for you in those ways, or if you want to make that shift from traditional Medicare to a Medicare Advantage, this is your time to take a look at that.
All right, Carrie, I have another question from you. This reader says, I am on Medicare, but still working and earning an income. Can I still contribute to an HSA account?
No. You cannot. If you have enrolled in Medicare, you're no longer eligible to contribute to a health savings account. But the brilliant news is if you have a health savings account, you can use those funds to pay for your deductibles, any of your out-of-pocket medical expenses that you may incur with Medicare. And so this is a great opportunity to use those for those medical costs.
And our final reader question, how much will my traditional Medicare premium likely increase for 2026? I want to start budgeting right now for it.
Yay, you should start budgeting, because here's the deal. It's going up. These are just estimates that came out at the end of July from the trustees over there at Medicare. And what they're telling us is that both your premiums and your deductible is likely to be double what it was, what the increase was last year. So what they're saying is premiums are likely to jump $21.50 to $206.50. And so that's your monthly premium. And your deductible, and again, this is for Part B of Medicare. These are your out-of-pocket medical expenses, doctor visits, that kind of thing. Your deductible will also go up, expected to go up, I should say, by about $31, which would take your annual deductible to $288. So yes, start budgeting now. These may sound incremental, but they do add up.
Carrie, thank you for always having the smart answers to our reader questions. Appreciate it.
Thanks, Allie.
Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter, and stay tuned for Market Domination that's coming up next.